Awesome. We are live here at the iComply Fireside Chat for unknown risks in corporate finance and due diligence for M&A. I am here at the table today with some industry panelists and experts. I wanted to introduce them. And starting with here on my right, David.
Hi, David Vijan here. I am CRO, or Chief Risk Officer at Outlier Solutions. We're a boutique, small compliance consulting firm, pretty much focused on anti-money laundering and counter-terrorist financing policies and procedures. We do other things as well, such as privacy, but that's predominantly what we do. Our focus is Canadian predominantly, but we do have experts that we can refer to for US and UK work as well.
Thank you, David. And also we have Georg.
Yes, hello. So this is Georgi Kotsev. I'm a partner from Saniana Associés, a Luxembourg law firm. I'm a financial services lawyer, and we mostly take care of alternative investment funds, their structuring, and obviously anti-money laundering procedures and rules, which are a hot topic, especially in the current situation where from the beginning of the year there have been some changes which are relevant to the topic today.
Thank you, George. And Matthew from iComply.
Yeah, it's Matthew Unger with iComply. I think my role is at iComply here is to really help to drive the product. We've seen a lot in the last, I would say, last year, maybe a little bit longer, a significant increase in the need for risk and assessments and due diligence in M&A transactions, private investment funds, private equity, things along those lines. And that's part of why we're here and bringing these people together.
Thank you, Matthew. And also we have Alex joining us.
Well, good morning and good evening. I'm dialing in from Hong Kong. My name's Alex Duper-Ursel, and I look after the AML practice of a group called Compliance Asia out here and deal with AML for a variety of financial industry clients.
Thank you, everybody. I'm so happy to host you today. Now, as we go through our discussion, as we are live on Periscope, Facebook, Twitter, and so on and so forth, please feel free to pose your questions from the audience in the Q&A section. We will address those as the call continues. But to set the table today, we're all here to talk about due diligence for M&A and corporate finance. And to open it up with some data, in 2019 alone, there were over 15,000 M&A deals that were processed, and $2 trillion of capital changed hands around the world. So I would like to open it up with the first question as we dig into these data details. What is M&A? David, you want to take that first one?
Yeah, sure. So merger and acquisition basically is a company that is acquiring, whether that be solely in full or part of an interest in another company. I think a lot will be seen in kind of the next few years as a lot of smaller tech companies are kind of merging and joining forces to be a little bit stronger. So that's essentially what it is in my own words from a Canadian perspective.
In these 15,000 transactions, all these deals, who would be parties behind deals like this? George, who's involved in an M&A transaction?
Well, we mostly, the M&A I think is important to add to David's observations is that usually M&A is related to non-listed, non-public companies, because otherwise we're speaking about kind of public offerings to acquire or exchange securities. So in the M&A space, more in, let's say, from a continental Europe standpoint, we will be working traditionally on companies that are not listed. So this can be virtually startups. It can go up to SMEs, and basically the limit is the aspect where the company is listed or not on a regulated market, and this kind of puts it in a specific space where we need to have a particular due diligence, as all these private companies, they don't have publicly available information, and this is where I think the topic is hot and relevant for analyzing the acquisition due diligence beyond, let's say, the formal one, like the data room stuff. We need tools to kind of identify what the company is, who are the beneficial owners, are there any related party transactions, but I'll just maybe let take care of that a little bit later in the conversation.
Well, you've led us to kind of the next point here is where do you begin? You know, you have this great opportunity at the table, and naturally as the startup business, you certainly want capital. How do you prevent or at least mitigate risk in this type of scenario? And Alex, maybe I'll pose that one to you. Where do you start when you're addressing risk in an M&A transaction?
The way we look at it is what the regulators require, and then from there's a series of commercial risks which you need to look at as well. So in the jurisdictions that we operate in, the regulators start by defining what sort of transaction they're interested in, and typically that's a transaction involving either an offshore company from the jurisdiction they're in, i.e. not a private company in the home jurisdiction, or an offshore private company, or a company involving the public markets, either a debt or equity transaction. So once it's in scope like that, then there's a series of rules that you need to consider in order to look at the risks of the transaction from a financial crime perspective. Is the party that is acquiring, do they have an appropriate background? Is the acquisition target the sort of thing which is conducting a business which is appropriate? And often when there's some form of ultimate funding involved, there's the more recent issue of where is the money going to be used, and is that appropriate as well?
Awesome, thank you, Alex. Now, from the audience, you know, we're talking about debt equity financing. We're talking about offshore corporations. If you have any questions around clarity for the topic that we're discussing today, please post it in the Q&A channel so I can bring it to the attention of the panelists here. Matthew, we've talked about now identifying parties. We have an M&A transaction at the table. There's risk. What would the regulator's expectation be around appropriate due diligence now that we've actually noticed there is something we should dig into? Where do we go from here?
Well, that's an interesting, depending on what stage of analysis the deal is at, and there's quite a few people here that I think, spend their lives looking at risk and determining, how to mitigate or remediate it. In some cases, first and foremost, depending on the level of sophistication of the people behind the deal, there can be risk associated with, let's say it's just a false positive. And by that, I mean that, we just do something as simple as we look up the name John Doe on a sanctions list, and John Doe appears, but it turns out it's a different John Doe than the one on our cap table of the company that we're acquiring. The next type of scenario could be that it's actually the right person, but is that risk actually relevant? Does it pose a risk to us in this deal? And then if you do find a lot of times in some of the deals that we're involved in, there's sometimes the hidden risks are behind structures, corporate structures, offshore vehicles, layers of trusts, or different things like that make it very hard to see who the ultimate or final beneficial owner, who actually who benefits from this organization existing at the end of the day. And so I think a lot of times, if there is any potential risk identified, the first step is to really make sure that it's actually relevant to the current situation, and then making sure as well that in many cases people will just do a cursory, because this is fairly new. And we've seen here in Canada, as an example, companies who have young companies who are under 5 or less years old that are now raising, hundreds of millions of dollars. They're getting fairly late stage, and in the earlier rounds, they maybe took investment from a state-owned enterprise in China, or an organization overseas that may have potentially some risk now in the current political climate in Canada. And so that kind of creates, we've already seen this where we've had deals that have had to have, because there is a known organization that has risk associated with it, where there's had to be quite a bit of deeper digging in order to identify if this transaction can even go through.
Now, in the beginning there, you had mentioned something I think we should expand on is the John Doe scenario. And David, I'll pose this question to you. How would you approach a situation where the parties involved are providing, either insufficient or incomplete data or documentation for you to actually perform the work that you need to perform from the compliance perspective? How do you handle the unknown?
So I think that's where it gets a little bit tricky. When it comes to owners of the particular companies, you need to dig until you've reached beneficial ownership. From a Canadian perspective, there's legislation around that anyone that holds or owns an interest in the company of 10% or more, you should be doing that due diligence on. So that screening and things like that should be done with the owners. It should be expanded as well. You may want to look at members of senior management teams on both sides of the equation. Particular vendors potentially that they have large contracts with that you want to be screening. Now, I mean, that's part of an acquisition. They may not be necessarily so forthcoming with some of the information, and that really is going to go back to a risk tolerance of, do we go through with this transaction if we don't know who's involved? If we don't know who we're getting to bed with, so to speak. So that definitely is important. Where, giving an example of John Doe, a very common name may come up. That's where you really would need to dig for information to make sure that is somebody on a sanctions list is not a member of one of your owners or senior management, etc.
Now, in the event where you identify that you have, potentially these false positives or negatives, how are you preparing the due diligence? And perhaps I could pose this question to Alex. How would you approach or prepare for a situation where in this corporate finance transaction, you have a party that is a Jose Gonzalez from an offshore entity, and it's just very difficult to find the data or details?
So the key thing with identification is looking for identifiers. And so you start with a person's name, you then look to find some other form of identifier. It could be some form of identification document. It could be just simply a date of birth. It could be a nationality. And from there, you start doing broad searches if, in fact, you don't have much to go on, and you start to go through a process of ruling people out. It can often be a very tedious process when there is a very generic name. It can be even more tedious in this part of the world where you've got the romanization of very common names, and often as you move around from place to place, someone has quite a different name as they move from country to country based on the local Chinese or dialect translation of the name. So you've got character issues, you've got, as in Chinese character issues, you've got the issues of simplified versus traditional characters, and it can be quite a challenge to go through and just simply identify a person. But you look for whatever you can get. You ask questions of the people that are a bit closer to the transaction than you are and see what they know to rule out more false positives. And it's a process you go through.
Thank you, Alex.
I think one of the other things, there's some really good examples there, and I think sometimes when you're digging into the names of people, mention of romanization is one thing. There's also even a name like mine, a very common name, Matthew, but there's Mateo, there's Matthias, there's Matt, there's alternative spellings, there's French Mathieu, there's all these different variations. And it's actually really important because one individual can easily go in one jurisdiction by one name and another jurisdiction just localize it, because sometimes people find it very hard to speak a name in a different language. I think these are really with some of the newer accounts that we deal with, when they see this, they're like, well, why is this person hiding their identity? in reality, a lot of this stuff is actually not about hiding the identity. It's just it just happens in the course of business.
Now, does anybody from the panel today have an example of a real-world case where an M&A deal failed due to due diligence or to the risk? I kind of love to hear, just your industry experience of something that you'd be willing to share or you took on.
So, without obviously disclosing companies and names, there was one that kind of failed, and a lot of it wasn't necessarily just related to the owners of the business and kind of that screening process. It had to do with the data. So the customer data, when you acquire another company, you're acquiring that data as well. This was a regulated entity, meaning that it had to comply with AML law. The customer data was not necessarily compliant with the Canadian law. So that deal kind of fell through because of that. So that kind of gets into, and we'll probably talk about this a little bit later, is, so we're talking about, the upfront part of the merger, but the deeper dive into the forensics, into the data that you're going to now own, making sure that that's compliant with various laws. And sometimes that can be a little bit tricky at, certain stages of an acquisition because there's privacy considerations. Companies may not be willing to share information. So what do you write into your agreements to kind of cover your behind on things like that?
Mm-hmm.
And kind of piggybacking on that last part is there, especially with that particular deal, was there any opportunity to remediate that existing customer base to bring it current to the Canadian standard?
Yeah, definitely. And while our regulator in Canada, from an AML perspective, FINTRAC, there really isn't anything in legislation, but there are policy positions from them that say, when you are doing an acquisition, make sure account information is up to date, that there is a process in place to make sure that that is. Now, obviously at the time of acquisition, there's timing considerations. You don't necessarily expect the company to contact all customers and get the required information up to date, but there could have definitely been a plan on how that could have been solved for, right? So.
And that is kind of like the deeper risk of the customer base and how that was even handled beyond the actual owners of the business and the corporation itself. It's a very great point. George, from your side of the matter, do you have any examples of perhaps a corporate finance deal or an asset deal that, due to risk, simply could not be done?
In fact, yes, that's a couple of cases where, especially in the private equity alternative investment fund sphere, these transactions are pretty much not transparent because there are assets which are gems considered by buyers and sellers, and the information is not widely available. But the advantage in regulated structures is that they do have AML rules and procedures, let's say, for identifying the investors, but these are also used in conflicts of interest policies and rules, and also in risk management manuals. So when we do an advise on acquisition due diligence, we follow first the rules of the entity itself, which is supervised often by a financial supervisory authority. And we have had the case where, by digging in on a potential offer to existing investors, we kind of end up with available tools, of course, IT systems and databases, to identify that since day one, there hasn't been a full disclosure about the identity of the ultimate beneficial owners and the kind of layering of structures, which, well, if we agree that offshore is anything that is outside the jurisdiction where the buyer and the seller is, not necessarily by speaking about Cayman BVI or whatever, because even that can be used properly and with a legitimate purpose. But when you have to dig in, and we're pretty much surprised to see what can happen in the UK, without saying that that's limited to that kind of situation. But most of the cases that have kind of been kind of taken to our attention are related to UK entities, where I kind of see that control in the trade register is not kind of the same that we may have on continental Europe. And due to the fact that we haven't had spontaneously the disclosure of this information on the related party transactions, this kind of, when you follow the AML rules and procedures, you have to kind of escalate if we base this on the proportionality principle. So by escalating, that means that you kind of have a red flag and you have to dig in for more information. Is this John Doe, Jose Doe, whatever? And when we put bits and pieces, then we do reputational research. And kind of at the end of the day, you do end up with a report which says more likely than not that this is a risk deal. You have a reporting obligation in Luxembourg, you have a compliance officer, and then you have a supervisor that ultimately takes the decision. But in this case, it's kind of, if we follow the logic, it's not necessarily in the strict meaning an AML issue that is subject to a suspicious activity report or a suspicious transaction report, but you're still in a situation where you kind of have to evaluate, I think, mainly the reputational risk that you have, that you transact with people that don't necessarily have a good reputation or have a far too complex structure to do a deal in that size and complexity. And to add like the cherry on top of the cake, the target on which we were aiming was it's self-regulated by a central bank in Europe. So this also kind of gives you an idea that once you run the due diligence checks and procedures, you can still kind of mitigate and say, yeah, okay, well, this is an SME. It has a balance sheet of 5 million. So what's the risk? Let's see how we can make a proper decision. But when you're operating on a regulated entity itself, it kind of goes in a way where you don't confirm interest and you just drop the deal, because all this has to be transparent since day one. So when you put all these breadcrumbs, it ends up at the end that you have too much information that makes it more likely that you don't transact, that you rather pursue. Arbitrage between getting the money and getting the deal done, and the risk profile that is associated with such action. This is all why the FCA, since the beginning of the year, has been kind of reinforcing checks, controls, and pressure on private equity deals, because they have kind of identified also that there is an issue there that needs to be addressed very quickly.
A follow-up question for Matthew. Is there any guiding principle around potentially knowing too much? Can you ever know too much in one of these transactions? George's case is there. You've overloaded yourself with potential risk. What are these guiding principles around the thresholds of what matters, and kind of where you draw the line?
That's a good time to, if you have to ask those questions in the deal, it's a good time to talk to someone with a lot of experience involved, because it is very much a case-by-case situation, at least from my perspective. I don't know if the people on the call here would agree, but where you look is also, it costs money often to acquire this data, to do this research, to do the digging, to do the analysis, and you could spend literally millions of dollars on it if you wanted to, but it doesn't necessarily mean that more is more effective. So I think that's sometimes a really important part of having people with the right experience to make sure that they actually know where to look. And I can think of one example, a deal out of Luxembourg where the deal had almost fallen through because the source of wealth seemed questionable, and it was the acquiring company was looking into the company being acquired, and there was a lot of cash on hand, and they were saying, the acquirer had a lot of cash, and they were saying, well, where did this money come from? And it happened to be from certain type of agricultural enterprise, and they said, oh, it came from this type of farming, and they, in looking into the deal, they couldn't see anything associated with farming. other than the risk officer involved in the deal, noticed this one address, and actually through Google and a number of other things saw a sign on this, an old sign on the side of the building that literally had the name of the farm right there. Hadn't been taken down. It was no longer operational. It was just a holding company at this point. But by knowing where to look, was able to actually verify that, yeah, what the client said, was the source of wealth, was actually the source of wealth, and was able to kind of use that to pull the pieces together. In other cases, I think we've seen deals where, where they've fallen through, like in David's point, beyond just, looking to see, is this company listed as a bad actor? Is there any sort of adverse media associated? But where it comes down to data, or even in the case of tech companies, their code. I've seen, we've seen a deal here in North America, I think it was last year, where it fell through because the due diligence on the company itself, on the directors, the shareholders, that stuff went fine. But then when it came down to where did they acquire the code, it turned out that it was kind of begged, borrowed, and copied from a whole bunch of different areas, and the company didn't actually really own their IP. And that kind of creates a whole nother scenario of a risk where, further to David's point, it's, your agreements of how the deal is being done, and when can you say, hey, wait a minute, this isn't what we signed up for, is actually an important part of putting a successful deal together.
Thank you, Matthew. Alex, I had a question for you that came from what Matthew was saying there, around the fact of when you're actually processing one of these transactions, and can you give me an example of when somebody has not done enough, when a deal that you saw go through that later came back because the procedures were not correct from the get-go, yet the transaction was still completed?
I think there's a large graveyard full of those sorts of deals. I mean, probably one of the most topical ones in this region at the moment would be all those poor folks who were massively invested in Lucan Coffee and the IPO that went with that. That was a case about false sales and about inflated business results. There's been an enormous amount of fraud out of this region that's ultimately found its way onto the US public markets. Due diligence, unfortunately, is not something which has been something that has been well undertaken by the parties involved, and that's evidenced by the amount of regulatory action that's been taken against the arrangers to these deals. A huge number of financial penalties against the big bulge bracket investment banks, all the way through to local guys who also get caught up in these things. Part of the problem, and without wishing to sort of skip around your question, which was about give us an example. I mean, there are just so many examples that you pick up the Wall Street Journal, you'll find them on a regular basis. So I'd rather talk just a bit about, well, why is that happening and happening so systemically? The main reason is the guys who engage a lot of the due diligence along the way, the advisors, they get paid if the deal's done. And so there's not a lot of incentive from their perspective other than the regulatory stick that's wielded over them to look in any great detail into the nature of the transaction, be it the way that a transaction is vended in, frequently at overvalue or frequently via other intermediaries who are connected to management, or whether it's there's something not disclosed about the nature of the business, as Matthew was talking about maybe some integrity issue relating to the underlying assets. So it's a very challenging process to be involved in an acquisition, and it seems as though everybody's desire is to get the deal done. And then along comes this bloke who says, or this girl who says, no, you should have a second look at this. Well, so then people start not getting paid, and they start getting very upset about that. So it's a tough thing to work through.
I just want to add to that. I totally agree. It becomes a check the box type of exercise versus a true due diligence. And this is where, formalizing a true risk assessment of what all the risks are and kind of, listing them, understanding them, prioritizing them, and giving them a rating becomes very important, right? If it's just a checkbox because people want to get paid, there are going to be ramifications eventually of some sort, and we've seen many of those.
George, I'd love to hear from your perspective, because we talked about who would be impacted, and then, of course, what some of that fallout would be. But what are the consequences of pushing something through that ends up in front of the regulator and you have not addressed your risk and you've done this improperly? What is that overall fallout like? Are you going to find yourself sanctioned and unable to do business, or what are the ultimate consequences for those involved in the transaction?
Well, if we take the regulated standpoint, and speaking typically of an alternative investment fund that is doing a private equity transaction, the answer is pretty much clear. If you get caught, then you kind of face criminal sanctions. So it's criminal prosecution because you're in violation of anti-money laundering rules and regulations. So that's quite crystal clear. But on the other side, I just wanted to add to what Alex and David said, is that in regulated entities, it's rather, I won't say easy, but you have an existing organization which is supposed to protect the chief compliance officer in order to give him the full independence and not be under the oversight of the chief investment officer, so that these kind of people don't get into interaction. And what you see on let's say in some cases, I've had people speak about like some movies on Wall Street and everything else, where you have CIOs and compliances that just can't speak to each other and be in the same role. Some people don't understand that, but that's just corporate governance, and these are the things that actually protect the compliance officer to do his job properly. So what is not understood is that if you have a compliance issue which is raised, it's just, especially with AML, it's quite serious, because you can have a conflict of interest and you can deal with it if it's properly disclosed and you have a pricing and you kind of explain that this is on arm's length transactions, which is one thing. But as we're speaking about anti-money laundering rules quite today, it's just the thing that if you skip the due diligence, unless you're lucky, then you can pretty much be comfortable. But the due diligence is there just to check and have this 4-eye principle, where the person that is actually driving, you have another one next to him looking in the back, kind of rear mirror, saying, do we see the same thing? And maybe you missed it because you want to get the deal done, but this is just raising a flag. We looked at this is our analysis. You're the person that takes the decision and you're ultimately liable. So it's not kind of a thing that, you kind of throw this thing to the next person, but there is really a meaningful role of performing this, which is today an industry standard. And I've been pretty much surprised as a lawyer and as a fund director to see a lot of deals that actually begin without any proper due diligence. As to if proper due diligence was performed before engaging into the transaction, I would say 7 times out of 10 you won't even engage into transaction and lose credibility towards the counterparty that you have on the other side of the table, because in our case it's more acquisition. But when you're disposing an asset, if it's not an IPO, you still have to check also where is the money coming from, what David and Alex mentioned already. So if this kind of, and I think this is the worst case scenario, is if that you don't raise the flag and process and deal it, and you have a case where you are facing AML, you have an AML issue and you have to report it. The worst thing is that you raise it to CIO, then that's kind of not, your advice is not followed, and then you get the bank file a SAR. So you just end up, I mean, there's so many people now in the whole chain of deal that if you don't refrain and stop and block the deal, then you're very likely to have the bank file one, a public notary file one, maybe even the lawyer file one. So this is kind of a situation where today, if you have three other entities that have filed it and you're the only one that hasn't, it's kind of a little bit suspicious. Mm-hmm. So it's better to always perform the due diligence, do the identity check, identify who the people are, run the sanction list, PEPs, everything. We've ended up finding that remote directors in, again, UK companies are PEPs, but once you assess what kind of PEP that is, what's the role in the company, whether that's related to income, fund flow, you can say, yes, it's better to say, I identified it, I have processed it, it's not a red flag, then we move forward because it doesn't impact the origin, the source of funds, full stop. But I think it's worse if you say, I didn't see it. So this is the point of doing it properly, to my opinion.
Right. Once you have it documented, that it's there. And it becomes a risk tolerance exercise for certain things. So definitely the due diligence and that formal documenting of that is key.
Now, as you dug into kind of the roles of who's involved in the transaction and who on your team from either side of the transaction that is participating, Matthew, I'd love to hear from your perspective. If I was a business owner, or corporate entity owner, or a venture investor, who should I surround myself with? Who should be on my team to help protect me, to help me identify risk, to actually carry me through this transaction so I have a positive outcome at the end and don't expose myself to unnecessary risk?
Well, I think we have maybe some people on this call that can speak to some of their own experience in that area. It really does, again, depend on what type of deal it is. But let's say, as an example, you're talking about a private equity firm. There's going to be a need for for having somebody who's a lawyer or independent counsel or in-house counsel who's got some really good experience with M&A, but more and more, especially in some of the markets where the regulators seem to be paying very close attention. There was actually a document reported by Reuters to have been leaked from the FBI saying that there's the FBI, along with several financial regulators and financial crime agencies, are doing a lot more investigation into private equity, venture capital, etc., because it just has become, 10 years ago, the private markets were much, much more illiquid than they are today. And the more liquid they are, the better a vehicle they can become for things like laundering money. And so there's a lot more looking into this area, what we see for example, in the US market. But I think one of the areas that, as this becomes a bigger thing, having people that have the expertise in the individual areas. So just because somebody is, a lawyer with corporate M&A experience doesn't necessarily mean that that they even have the right asset on their team to do the AML due diligence or to do the data. And some of the examples that David gave earlier are perfect examples that really the type of deal will change the type of due diligence that needs to be done. And you might need people who have a little bit more expertise in some of those areas.
Awesome, thank you. And Alex, I have a question here for you as we are starting to get some Q&A from our audience. I'd love to introduce that to the call now. And this gets back to what David and Alex were actually touching on just a couple of questions ago. The temptation to skip proper due diligence seems quite high in private equity. And as Matthew pointed out in the Reuters leak, the FBI seems to think so too. Do you think that the opinion still outweighs the fear of being charged in the future, that temptation to push something through, Alex?
Well, I guess the first thing from the perspective of the private equity firm is how much skin in the game do they have? the more skin in the game they've got, the more that they are quite interested in the commercial side of the due diligence going through and ticking the boxes for them. They clearly want to make money out of the deal as well. Obviously, the type of structuring around that is also relatively important. If it is a closed-end operation, like most private equity firms are, they get paid at the end of the day. They get paid on the termination event, and so they're in it for a fairly long-term haul. So due diligence at the beginning is important. The sensible ones are doing it throughout the process as well. In terms of regulatory breaches, it's a little different. The deal could still, in theory, be done, and yet you could be treading all over a sanctions problem, which is extremely dangerous for a US person and for any person whose nation has decided to sanction that particular transaction or individuals. And you then have the more difficult areas of criminal influence or inappropriate business methods and so forth, which can all look fantastic on day one, but on closer examination, people come back and think maybe not. I don't think that any of the significant private equity players, and that's a pretty deep list, all consider this as a fairly important and regular part of their business activities. But from time to time, the attractiveness of a little unicorn that they happen to have discovered that happens to claim to have some massive portion of the mainland Chinese market and they want to bring it onto NASDAQ as quickly as possible, does tend to get in the way of maybe a little bit more thorough due diligence than people should be taking. I would add to the comments that the previous speakers have made that in organising the team around you in this region, there's two really key things, and I sort of started doing due diligence back many years ago, sort of really before the internet was quite active, with Kroll in the mid-90s here in the Asian region. And the key thing that we used to find with everybody was that you need to find someone who really understands the jurisdiction or jurisdictions really well. And often the acquirers just may not even speak the language, may not have spent much time in country, so don't understand culturally what's happening, don't understand the basic stuff that a person on the street understands because you've lived with this company as they've grown up, you know something about the history. And the second thing is then finding someone who knows something about the industry, because of course there could be some aspect which is industry specific as well. So finding those people and adding them to your team is a really critical part of the whole process. If we use the Lucan Coffee example as just as a broad framework or canvas to think about, you need to get out there and spend some time in those Chinese cities looking at the traffic through their stores and talking to customers and trying to figure out whether in fact the numbers stack up, or maybe on a city-by-city basis, and then some extrapolation in relation to that. But you need to get on the ground, you need to burn some shoe leather, and you need to talk to some people about it. So I think that it's very much appease firms' desire to ensure from their own reputational standpoint that they get their deals right. Their institutional investors aren't very happy with them if they are continually losing, or their LPs. From a regulatory perspective, it's a bit harder. There can be very complex regulatory rules sometimes. Other times it is just as simple as you haven't checked for a sanction. So a bit of a difficult one, but broadly I find most private equity firms are keen on getting the process right, but there's the occasional one who's not.
Awesome. I just want to thank our audience for these great questions here. I've got David and Alex's thoughts on the temptations. I'd love to pose another question from the audience to Jordan and Matthew here around a real world example. Because one of the most widely discussed deals today is the acquisition of TikTok by Microsoft. and this has to go through in 45 days before the app is banned in the United States. What are the main AML risks associated with such a tight window in this deal in particular? George, I'd love to hear your perspective.
Well, this is just my really remote opinion, but also something that was mentioned by other speakers before is that what we have to consider here is that if we take a definition of a private equity deal, it's usually companies that are kind of above the 500 million mark in Europe, at least. So if we look at major private equity houses like Pipe Partners or whatever other big players in the region. So these guys, they have funds that are oversubscribed, and usually they target 4 to 5 billion per fund size. In these kind of transactions, nothing is really left and to kind of assume any kind of risk. So the sizes of the companies are the type of companies which are audited. I mean, it's pretty crystal clear how the shareholder structure of the company is. We have tons of history, so it's pretty much easy. And this is just a stepping back to go forward and answer the question. Is that we're speaking about Microsoft, which is kind of a very big corporation and has one of the biggest aside Apple. And I believe that if they have to have everything done by these 45 days, they're going to put the resources that are necessary, considering also the stakes at hand. And I think that pretty much there will be bits and pieces, but at least from an AML standpoint, everything will be done. Because speaking about the AML is one thing, but what also Alex was referring to, local culture. In some countries, you can buy an apartment and pay cash 100,000 euros, and the buyer and the seller take the money and bring it to the bank and put it there. But it's just a question of, if you know how local customs are and how people transact, it doesn't really startle even the notary to record such a transaction with having the money on the table. But it's just, that's how it's transacted. Now, in this case, I think that from an AML perspective, there is no issue. Now, maybe I'm wrong, but I think from an AML standpoint, the due diligence won't be very difficult to perform within 45 days if they put the financial and human resources to make it right.
Yeah, I would agree. The 45-day timeline is going to be a good sprint. That's for sure. But again, like George said, there's the assets. The acquiring organization, Microsoft, has whole teams, built for this purpose. The question did specifically refer to AML risk, and I don't, I've never done any background checking on a company like TikTok, but one of the things that I think beyond AML that I would definitely be looking at in a deal like this as well is, we know that with this, part of the concerns for this acquisition that triggered all of this was around what happens with user data, and that's been a pretty big concern. And so I can imagine that the M&A team here will be looking at the code. Where is data processed? Where is it being stored? How is it being stored? Who has access to it? Are there any backdoors? I think those will be questions that that they'll want to make sure that they understand very clearly as they're going through that due diligence. But yeah, from an AML perspective, I imagine it would be very similar to other types of investigations. I've never heard of anything related to TikTok with anything money laundering or terrorism financing or sanctions, anything along those lines before. But even who are their shareholders, who are their directors, and is there any risks associated with those counterparties as well? I can imagine that that'll be probably a bulk of the AML work done on a deal like that. Now, David, did you have any thoughts on your side?
I was sorry. I was going to say I think it could be really interesting, that whole deal, because the time is obviously everybody's looking at and focusing on, but it's an entity that's the app itself is owned by a group called ByteDance. They've been around for quite a long time. I'm not sure how much transparency there is around their where the incomes come from, where the nature of the underlying business itself and the revenue streams that are attached to that, and the folks that are involved there. It's a very widely dispersed retail business, and that carries with itself lots of risks from an AML perspective, not at the top level, but at the level of users and what those users are doing online and so forth. And Microsoft, being a US public company, has a very high bar to pass in terms of the type of where its money goes when it acquires someone. So I think it could be quite a complex process to go through. I certainly wouldn't want to be the general counsel in a timeline like that, and with obviously all the politics around it. It's pretty challenging. But hey, maybe it'll be a great deal. It'll be interesting to see.
Definitely. I think one other thing, it came up, one of the previous questions actually was asking around kind of the carrot and the stick. You want to get the deal done, but then there's, the fear of the regulatory piece. But I think there's also quite a bit of other potential risk other than just the regulator coming out with a stick. Everything from lawsuits from, either side or their shareholders. Any number of, especially when you look even in vendor relationships, some of these contracts can even expire in the during an acquisition, and all of a sudden you have a competitive edge that you lose and might have been a key foundation in the deal. So there's, I think in a deal like this, there'll be a lot of extra things to be looked at other than just simply AML.
And it seems like the environment today, just from the regulator's perspective, it's quite dynamic. A great example is in Belgium on August 15th, a new AML directive is coming into full effect. And this ties to our next question from the audience, which I'll start with George and go around here. But are there major changes in due diligence for M&A or corporate finance that you see happening in your region similar to this new directive out of Belgium?
Well, it is. This is what we meant. I mentioned a couple of times since the beginning of the fireside chat, is that there is a major trend, and especially in Europe, we have lots of things going on since more specifically, and second half of July and up until even yesterday and today. You mentioning Belgium, I just mentioned in the UK. David spoke about what's happening also in US and Canada. So this is like a convergence of a global trend. And while regulators were focusing mainly on the financial services industry, where this has been applicable for a very long time, there has been pressure from the FTF also when they're auditing countries. Like we had an audit in Luxembourg a year ago. We had this report with specific sectors that are more risky than others in respect of money laundering. So I think that the purpose was there to say, yeah, well, okay, you have the AML, but then banks and financial institutions have to actually enforce it because having the rules is good, but if you don't enforce it, it doesn't really make sense, because at the end of the day, it's the same thing. And I believe that the next step was that the regulators, and I think OECD, FATF force, kind of realized also that if you're doing money laundering, if you're doing money laundering using banks, they do this tick the box, exercise, and then if you don't have the reporting, which is linked like with FATCA and common reporting standards for Europe, then it doesn't really make sense. So now that all this has been put into a well-working machine that is producing results, the regulators are clearly focusing or have focused on virtual asset service providers. And now I think that the big next chunk is really the private equity world, in which the banks do their job because they usually are holding the bank accounts of the businesses that are transacting, seller and buyer. But there are a lot of small size deals where it's very complex to identify and assess whether there is an AML risk. And getting back to what Alex said also earlier today, is that you also need forensics accounting in order to make sure that the business that you're acquiring, the figures kind of match, make sense, are consistent. And in a recent private deal, it's not a private equity deal, but it's just an acquisition of a trade. Actually, the accountant helped pull out the figures, analyze them, and he noticed that occasionally the business owner was putting cash in and taking cash out on specific periods of time over the year, which kind of, I mean, you can be a lawyer, you can be an AML specialist, but if you don't have the forensics accountant dig into this and identify the risk and say, yeah, you know, I have matching periods where you have cash on the account withdrawn and deposited, and each year it's more or less at the same period of time. He was even capable of kind of identifying what was the delta of the amount that was kind of not necessarily identifiable from where it's coming. So yes, the trend definitely is that the next step is private equity. Now, private equity, if we understand it, like deals which are between 250 and more millions, I think that space is pretty much covered by professionals, by teams that are used to doing this kind of exercise from an AML standpoint. Where the bulk of it is, and I don't really think, but in terms of absolute amount, that's the biggest part of it. But where there is definitely something that needs to be done is for small businesses, startups, and kind of growth capital and everything else that is related to the growth stage of companies, where companies are eager to get the cash, and sometimes they're not so much regarding into whether there is a consistency of source of funds, amounts, occupation, age. I mean, these typical risk matrix scoring models that basically come out with something which makes sense or not. So the money is just there. We need it to grow the business. We'll take it. And I think one of the questions goes that way, is we take the cash, we grow, and then we see if the risk is kind of acceptable for the business owner, then he just goes for it.
Yeah, I think there's, it's interesting on that last point you made, is that there's, especially in the, early stage companies that are, you strapped for cash, you're trying to find investment, you finally have someone who says yes, and then you say, okay, great, let's get that check. Get that check while there's still a yes on the table, and so the due diligence can often stop at, does the check go through, especially with younger companies. And one of the things that we've seen, even when we were starting out raising capital in the angel investors, VC investors, when they looked at what we do in the world of KYC and AML, they said, well, we don't have to do this in our industry. And it was actually a bit of an education point where we realized, in order to find proper investors, we had to actually demonstrate that, this isn't just a process of, pinging an OFAC consolidated list and saying, okay, this name isn't on that list, great, we're done. There's a lot more complexity involved. And I think it's something that we're starting to see some industries, we mentioned private equity, but I do expect that we will see venture capital and potentially even angel investments. Some of these groups, some of the angel groups or VC networks have just as much capital to throw around as the private equity ones, even if it's in smaller tranches spread among a lot more LPs. But there's definitely, seems to be a bit of a shift. What we've seen here in Canada, at least, a bit of a shift where some of these deals are getting a little bit more scrutiny from anti-money laundering perspective than when before there was none. And so, we may have a law firm that reaches out to say, hey, our client is sitting waiting on a, multiple 100 million or tens of millions of dollars investment, but now the new investor has questions about the current shareholders. And this is something where even in the U.S. market, we see quite a bit. If there's investment coming from offshore, meaning not in the U.S. but from other countries, especially specific countries, there's quite a few firms that will shy away from the investment if they start seeing investors that have structures from certain jurisdictions or things that just will make it not necessarily mean that there's anything wrong, but it's just hard to get enough data to verify that it's right.
I think part of the shift, especially here in Canada, to add to what Matthew was saying, for a lot of these smaller companies that are not considered regulated entities, there really isn't much guidance out there. So the change is going to come from, litigation risk and reputation risk that's kind of happened to other players along the way. I think in past, the focus has really been on, your typical, the financials, right? So, whether that be profits, the financial statements, capital requirements, liquidity requirements, the technology focus has really been more from a coder, IP, intellectual property perspective. I think we're going to see a shift for technology to look at what we brought up with TikTok. So privacy. Where is that data going? Who's holding that data? How secure is that data? So I think there's going to be a shift for compliance in general. So privacy being one of those, the AML risk, and even if they're not a regulated entity, as we've been discussing, who are those owners, and is there any AML risk related to those and where the funds are coming from? Compliance in general, I think as well. So other regulations, and I've seen that along the way of, there are things of to ensure that the company has been compliant with various legislation that they need to in their jurisdiction. So I think there is going to be more of that focus on compliance and privacy and cybersecurity and those types of risks versus the litigation and tax and financial statement stuff that you typically have seen with acquisition mergers in the past.
Thank you, guys. And just to post to the audience as we near the end of this call today, I'd love to see if there's any last-minute questions or Q&As that come from there. Please feel free to drop it into the Q&A portal. But until I get another one here, I'd love to ask David, in your experience, how do you deal with issues related to insufficient data as you perform your due diligence and your transaction?
Insufficient data, I think really it boils down to what I said, formalizing that risk assessment. And it depends what type of data is missing. There's going to be risk tolerance, and that risk tolerance is going to be discussed amongst many people. And we talked about having the right players at the table, right? So you're going to have your finance people, your operation people, your lawyers, consultants from an AML compliance perspective. I think it really boils down to a case-by-case scenario and what the risk appetite is and that missing data. Doing your due diligence and trying to dig for that missing data is going to be key in documenting that. And I think that's going to help, determine if the deal goes through. So I really think it is on a case-by-case situation. There are certain things that, if I saw, I would say no. Going back to something like beneficial ownership, if you can't dig down and it just seems too complex, it's probably something, in my opinion, I would stay away from or advise other people to stay away from. But again, risk tolerance is going to be different for everybody.
Awesome. I think that exhausts the questions I have from the audience. And
I would be curious. I think maybe if I can pose one just to the panelists here as well. We mentioned, and David, you mentioned, especially with some of these earlier stage companies and not having the resources. In each of your experience, where do you see, what if once you get to a private equity stage? We said here we're thinking, private equity is kind of defining 250 million plus. Once a company is raising a 5 million, a 20 million, a $60 million round, they're before that, they're maybe before private equity at this point. But what are some of the quick tips? Maybe what are some of the key things that they can do in the earlier stages to prevent some headaches down the road?
Seek the right people, I think. The resources may not be internal, but the dollars that are at stake is independent counsel, your compliance people, your privacy people, whoever you need to be at that table. I think that's going to be key, is having the right players at the table earlier versus later, just to see if the deal is even capable of going through. And due diligence, there's multiple levels, right? So there's the initial due diligence, there's kind of the later, and there's final. I think having the initial due diligence and the right people there is key to any acquisition or merger.
Alex, I'd love to hear your thoughts on that as well.
Well, I could probably just summarize it down to a very short sentence. If it seems too good to be true, it probably is. That's helped me with due diligence for a couple of decades now. Sniff around, talk to lots of people. Even the poorest party to any form of transaction can always sit and talk and listen and get on the ground and go and spend some time, kick the tires, talk to staff, talk to suppliers, talk to other people who may have looked at these deals before or looked at the industry before. We've got so many fantastic methods of communication, so many fantastic ways of doing research, both overtly and covertly. Use them and get out there and build your own data set and try and find the risk issues that you think you want to drill into, or you may need some professional help around those things.
Awesome. Thank you, everybody. Now, I'd love to wrap these events up with a little plug for everybody that was kind enough to donate their time to be a part of the panel today. So starting with you, David, I'd love for you just to let people know where they can find you online if they want to look you up after this video.
Yeah, sure. You can look me up on LinkedIn, David Vigen, but company's website is outliercanada.com. Again, if you need help with AML from a Canadian perspective, definitely reach out to us, and we'll be happy to assist.
Thank you, David. George, where can people find it?
We recently merged with another law firm, so basically we switched from KG to Senior and Associates, so we're basically a bigger team now. We have five partners in Luxembourg, so you can just type in internet Senior and Associates, and you can very easily find us if you need specific advice on AML research, consulting, on building digital onboarding systems. And I know that we have spoken with Matthew before this, is when it comes to doing corporate due diligence, that's one of our strengths, and we can help build up maps and relationships very easily to actually look back and see where things are coming and going.
Thank you, George. And Alex, where can people find you?
I've got a pretty unique name, so it's pretty easy to find me on LinkedIn. And my company's called Compliance Asia. So if you want compliance and it's in Asia, you probably Google that and hopefully find me, and not too many of my competitors in Google AdWords up the front. Just go 5 or 6 down below.
Thank you so much. And a special shout out to moderator Matthew. Matthew, where can people find you online today?
Yeah, LinkedIn's probably easiest. Matthew Unger with iComply Investor Services, and I'm on Twitter as well at UngerMatt.
Awesome, thank you. And of course, I was your host today, folks. You can find me at andrew.w@icomplyis.com if you want to contact me via email. Thank you, everybody, for joining today. Our next event will be August 27th. It'll be a fireside chat around e-signatures and their legality at law firms. I would love for you all to come back out and join us for that. And I once again, thank you so much for your time today.
Thank you very much, Andrew.
It was a pleasure hosting you guys. Please.
Take care.
Bye.